Long-term wealth can be acquired through stock investing, even when the markets are down. But getting going might be challenging. The days of calling a broker on Main Street and requesting 100 shares of General Electric, those days are absolutely gone. These days, you can purchase baskets of stocks or bonds all at once using a variety of investment vehicles, sometimes known as funds. That's fantastic news, because you should be working to create a diverse portfolio at a reasonable cost. You can avoid placing excessive bets on any one firm or type of investment by diversifying your investments. Hello 101 community, welcome back to our YouTube channel. We are going to talk about mutual funds, index funds, and ETFs. We will talk about their differences and similarities and which one should be the best option for you. But before we begin, if you're new here, make sure to subscribe to our channel and turn on notifications to never miss any updates. Let's get started. Due to their popularity in retirement plans like 401ks, mutual funds continue to lead the pack in terms of total assets. According to the Investment Company Institute, U.S. mutual funds had about $23.9 trillion in assets by the end of 2020, compared to $5.4 trillion in ETFs. However, investors have been drawn to ETFs during the past 10 years because of their low costs and simplicity of trading. You can invest in a diversified portfolio using either type of fund by purchasing only one security. For instance, you can purchase an index fund based on the S&P 500, a ranking of the 500 largest American corporations, as a mutual fund or an ETF, or you may use either to purchase a collection of bonds. Mutual funds. An older method of enabling a group of investors to own a portion of a larger portfolio is through mutual funds. Since they are frequently actively managed and aim to outperform their benchmark, mutual funds may have higher expenditures than ETFs, including the potential for sales commissions. Commonly, mutual funds have minimal initial purchase requirements and can only be bought after the market has closed, at which point their net asset value is determined. ETFs. ETFs are a more recent method of enabling investors to own a portion of a bigger portfolio. ETFs frequently follow a predetermined index of assets rather than having a portfolio manager choose their holdings, which is known as passive management. They often have little overhead costs and no sales commissions. Even though certain brokers would not let you purchase fractional shares of ETFs, they often do not have a minimum initial purchase requirement. ETFs can fluctuate in price around their net asset value and are traded throughout the day like stocks. Index funds. Any investment fund created to follow the constituents of a financial market index is an index fund. Index funds have significantly less liquidity and flexibility than ETFs because they must adhere to their benchmarks without taking into account market conditions, and orders can only be filled once per day after the market closes. The investing philosophy behind an index fund, the original passive investment vehicle, is that the market will outperform any individual investment over the long run if a portfolio's composition matches that of a certain index. An index fund can follow any financial market, including the most widely followed in the United States, the S&P 500, and the largest U.S. equity index, the FT Wilshire 5000, as well as the Bloomberg Aggregate Bond Index, the MSCI EAFE Index, which tracks stocks in Europe, Australia, and the Middle East, the Nasdaq Composite Index, and the Dow Jones Industrial Average. For instance, an index fund that follows the DJIA would invest in the same 30 firms that make up the index and the portfolio would only change if the DJIA's composition changed. The fund manager will periodically rebalance the securities to reflect their weight in the benchmark if the index fund is following a price-weighted index, which is an index in which stocks are weighted in proportion to their price per share. Although less adaptable than ETFs, index funds offer the same superior long-term returns. The simplicity of index funds is another advantage that makes them appropriate for many buy and hold investors. Without a brokerage account, an investor can acquire index funds through their bank, which has contributed significantly to their popularity. Key differences. Number 1. Investment and management style. The management and allocation of money is the main distinction between index funds and other mutual funds. Fund managers must choose the asset mix and investment percentage in actively managed mutual funds. As a result, a fund manager's knowledge, impartiality, and skill set have a big impact on how these funds turn out. Index funds, on the other hand, are passively managed. These funds invest in the exact same units in the same ratios as well-known benchmarks like the Nifty 50. In this sense, these funds tend to mimic the characteristics of their underlying benchmark by using it as a framework for investment. Thus, index funds provide a more passive method of investing. There are a few notable cost variations between ETFs and index funds. Both of these passive investment options are less expensive than actively managed funds, but they both have cost advantages and disadvantages due to how they follow and trade indices differently, such as taxation, cost drag, dividend policy, and redemptions. Overall, ETFs are more expensive than index funds due to the structural variations between the two investment vehicles. ETFs, for instance, charge lower redemption costs than index funds. When shares are sold, investors must pay redemption fees. Therefore, the ongoing rebalancing of index funds incurs both explicit expenses, such as commissions, and implicit costs, such as trade fees. By adopting in-kind redemptions, which replace monetary payments for sold assets with in-kind positions in other securities, ETFs can avoid these fees as well as capital gains taxes. ETFs have lower cash drag, a type of performance drag that happens when cash is kept on hand to cover the daily net redemptions that occur in index funds, which is another cost difference between ETFs and index funds. Due to inflation, cash has relatively poor or even negative real returns. Therefore, by investing all of the capital in the market, ETFs are able to generate higher returns. Performance. Mutual funds that are actively managed, particularly those that are equity-focused, strive to outperform the current market benchmarks. Based on this objective, fund managers mix and match their assets. These funds outperformed the market and provided better returns during market declines in various industries. Most of the time, though, that's not the case. Over 80% of the time, index funds have outperformed actively managed funds. This is so that the former can better mimic successful benchmarks like the Nifty 50. Rather than outperforming their underlying index, they frequently mimic it. There is minimal probability that index funds will do worse than active funds during a weak market. The majority of investors prefer to maintain a mix of active and passive mutual funds for this reason. In this manner, greater profits from one can offset a lesser loss from another. Simplicity. Before choosing an active fund, an investor must conduct a thorough amount of research before investing. It is important to take into account historical returns for the fund management, total AUM, assets under management, and other factors. Conversely, index funds that follow the same index typically have comparable returns. The decision is straightforward, and it largely depends on the expense ratio and the tracking error. If you liked the video so far, press the like button and subscribe to the channel. Also, if you want to develop yourself financially and want to take your future into your own hands, check the links in the video description. Passive management versus active management. Your costs and potential profits are heavily influenced by how a fund actually makes investments. Some funds use an investment strategy known as active management, in which the fund manager decides which stocks to buy and sell and at what point. This method is more frequently used with mutual funds. The alternative strategy is known as passive investing, and it entails the fund manager imitating an index that has already been chosen, such as the S&P 500, rather than choosing the investments. Despite the fact that ETFs can occasionally be actively managed, this method is more typical of ETFs. Therefore, in general, ETFs have been passively managed, while mutual funds have been actively managed. Fund returns and costs. The conclusion of the active versus passive investment argument is that passive investing performs better most of the time. In fact, new research from S&P Dow Jones Indices reveals that over a 20-year period, ending on the 31st of December 2021, 90% of US active managers in major corporations failed to outperform the market. Yes, the top funds can outperform their benchmarks, often the S&P 500 in a given year, but active managers struggle to excel over the long term. The objective of passive investing is not to outperform the market, as is the case with active managers. Passive investors, on the other hand, merely want to mimic the market. Additionally, as passive investing outperforms the majority of investors, you can defeat the majority of active professional managers. ETFs, which are normally passively managed, again, some mutual funds are also passively managed, benefit from this. To find out, read the prospectus for the fund. Another drawback of active management is that it typically costs more than a fund that is passively managed. The cost of mutual funds has decreased as a result of the advent of cheaper ETFs. Expense ratios for funds have been decreasing for the past 20 years, as seen in the chart below. Whether you're comparing a simple average or an asset-weighted average, stock mutual fund expenses continue to be higher than those for ETFs. The asset-weighted average tells you what a typical investor could actually be paying, whereas the simple average provides you an estimate of what you'd spend if you randomly selected funds. Accordingly, when comparing their respective average costs, mutual funds are significantly more expensive than ETFs. For instance, an asset-weighted average mutual fund would cost 0.50% of your assets annually in 2020. In actuality, you would incur a $50 expense for every $10,000 you invested. For every $10,000 invested, the equivalent average ETF has a cost ratio of just 0.18%, or $18 per year. But when you go further, the specifics change. As shown in the figure below, if you concentrate on passively managed stock mutual funds, they are actually less expensive than passively managed stock ETFs. Commissions and minimum purchases. ETF investors come out on top when it comes to commissions. The well-known brokerages have reduced commissions on all ETFs available on their website to zero. Therefore, trading these funds won't cost you anything, though some brokers can charge an early redemption fee. Investors will greatly benefit from this, especially if they like to dollar cost average their purchases. However, that is not the case with mutual funds, where some continue to levy sales charges that can cost you up to 2% of your investment and occasionally even more. Thankfully, many trustworthy mutual funds no longer impose these fees, and doing so is not difficult, because these fees benefit the fund management company at the expense of your returns. You should avoid them. Additionally, brokerages may charge you a fee for trading mutual funds. Some fees for mutual fund trades can be as high as $50. However, the top brokers sometimes offer funds with no trading cost at all. ETFs frequently offer a benefit here as well when it comes to a minimum purchase size. Although many brokerages now enable you to acquire fractional shares, a broker may often need you to purchase at least one share of a fund in order to make a transaction. Even if you have to purchase a full share, the price might be as low as $20 or as much as $250, which is still a sizable sum. In contrast, if you're starting your own individual account, certain mutual funds may ask you to purchase at least $2,500 to get started, with lesser minimum deposits after that. If you sell your position within fewer than 30 days, some mutual funds will also incur early redemption costs. Which one is safer? Because of how they are structured, neither the mutual fund nor the ETF is more secure than the other. What the fund itself owns determines how safe a position is. Bonds are typically less risky than stocks, while corporate bonds are slightly riskier than US government bonds. Higher risk, however, may result in higher long-term returns. Because of this, it's important that you comprehend the features of your investments. In addition to whether they are mutual or ETF funds, you won't be exposed to greater risk one way or the other because a mutual fund or exchange-traded fund tracking the same index will produce roughly the same returns. An ETF is a superior choice for investors for many different uses because it comes with some tax benefits, low commissions, and simple trading. However, in some situations, particularly for stock index funds, mutual funds might be more affordable than ETFs. Additionally, if they are held in a tax-advantaged account, their tax implications are also immaterial. In either case, you need to be aware of your investments and how they support your financial objectives. That's all for today's video. I hope you enjoyed it. If you want to see more videos like this, subscribe to our channel and click on the bell icon so you'll be notified of every update. Also, don't forget to check the links in the video description. And while you're here, click to watch one of these 2 videos appearing on your screen right now. I will see you there. Take care and stay tuned.